US dollar has surged rapidly over the past couple months, significantly tightening financial conditions in the process. This sharp movement has already affected the global economy, which has pulled back from its peak levels in November of 2024 and is likely continued to moderate lower in the near term. Welcome back to A View from the Street. I'm Michael Drozd, Chief Investment Officer for LaSalle Street. Stay tuned to learn more about how the US dollar's path may impact asset markets this year. As we closely monitor the US dollar's behavior, it is strikingly similar to its movements during Trump's 2016 presidential victory. Historical data shows that back then, the dollar rallied, peaking around this time last year. The turning point came in mid-January 2017, when Trump, just days before his inauguration, stated that the US dollar was too strong. This comment set the stage for a significant move lower, as the dollar declined for most of 2017. Fast forward to today, and it appears we are seeing a similar pattern, albeit a bit delayed. The dollar appears overextended, and President Trump's recent comments indicate he remains attuned to the dollar's impact. The current trajectory of the dollar mirrors the 2016 and 2017 period, suggesting a high probability of a move lower this year. This is one of the key tenets of our 2025 outlook. A weaker dollar, coupled with lower bond yields, could provide a substantial tailwind for risk assets as it frees up liquidity and eases financial conditions. Additionally, a weaker dollar has effects on global liquidity. It reduces the cost of servicing dollar-denominated debt, which is particularly beneficial for emerging markets. These countries, often burdened with substantial dollar debt, would have more capital to allocate towards growth, investment, and infrastructure in their local economies. A weaker dollar typically boosts commodity prices, easing financial conditions, and improves the terms of trade for commodity exporting nations. It encourages capital flows into riskier assets as investors seek higher returns. This increased capital movement and risk appetite are crucial for global markets. The dollar can be viewed as the fulcrum of global liquidity. A significant portion of the recent correction in global liquidity can be attributed to the US dollar strength. The recent pullback in equities from mid-December has largely been tech-driven. Last week, the NASDAQ 100 recorded its most oversold reading since April of last year, with only 19% of the stocks trading above their 50-day moving average. Historically, such conditions often mark a key turning point in markets. Currently, there is a palpable sense of fear among investors. This is largely due to the uncertainty around the implementation of policy of the current Trump administration. The dollar and yields have also surged in the fourth quarter, creating a significant tightening of liquidity conditions. As the lag effects take hold, weaker economic surprises are emerging. As these continue to deteriorate, we anticipate that the Federal Reserve may have to respond. If this occurs, we expect the dollar strength to be capped and the pressure from rising yields to ease. This should help alleviate the liquidity squeeze, providing risk assets with breathing room they need to rally once again. And while a weaker US dollar may provide a more favorable investing backdrop during this year, we continue to uphold our high-quality positioning in our multi-asset portfolios. We favor large US companies over international and emerging markets within equities and remain selective in both duration and credit within fixed income. In conclusion, the dollar's rapid appreciation has tightened financial conditions, affecting global trade and asset markets. However, if historical patterns hold, a potential weakening of the US dollar could benefit investors moving forward. Thank you for watching, and be sure to tune in to our next episode of A View from the Street.